All right, welcome to the show. I'm Mitch Goldberg. Thank you for joining me. You're watching Be the Boss of Your Money. It's about taking control of your personal finance. If you lose control of your personal finance, it's very easy for you to become controlled by for you to become controlled by extenuating circumstances. It's when you feel like you lose control of your money, of how the bills get so high, where's your money going? You don't feel like you're you don't feel like you're in control, and you need to do things to get back into control, to take control. It's not hard. It's not hard to do if you have the time to do it and have the awareness of where the money's going. Steps you could take, for example, look at your last 6 months of checking account statements, see what comes in, what goes out, see if there's a deficit every month or a surplus every month, or if you're flat every month. Look at what your assets are, what your liabilities are. These are the things that you can do to start to figure out where you are, what your income is, what you could cut, what you could do to raise your income. In some cases, you just can't cut anymore or you can't raise your income anymore. And you have to figure out what you're going to do. And then people get into debt and they can't get out of the debt. And they think, I'm just going to do it now, but I will turn this around soon, without a real plan about how they're going to turn it around. It pays to speak to a professional about this. It doesn't have to be me, just there are plenty of professionals you can speak with. The reason, by the way, that financial advisors are mistakenly considered personal finance people is because financial advisors are really about helping people who have money make more money, preserve their money, and use their money as efficiently as possible. And that doesn't apply to people who are just getting started, and it doesn't apply to people who've had some money troubles. This is why it's hard to access professional help. We have to get paid for what we do, and as a result, we can't really work with people who can't pay us. I'm a little different. I am happy to help somebody get on a better track. I can be a resource. I can't work with somebody 8, 10 hours a day, but I'm definitely up for talking to somebody, giving somebody some strategies to use, some things to look at, whether or not they're my client or whether or not they're ever going to be a client, because I just think it's the right thing to do. But we're going to talk today about comparing Cisco and Nvidia. Now, Nvidia, let me roll the quick intro, then we're going to get into this good stuff. Here we go. All right. Thank you for joining me today. And you're watching Be the Boss of Your Money. And here we go. I couldn't find the cursor on my screen. So let's compare these two stocks. This will tell you a couple of really important things, but I think seeing this incredible chart is kind of jaw dropping. So let's share it. All right. I'm going to make this bigger so you can see it. All right. This is quite jaw dropping what I'm about to show you, but Cisco just reported earnings. The stock is down a little over 5% after market trading. They're going to have to restructure, and Cisco is basically, ever since the dot-com era, the stock has never regained its former glory. So here's a chart. I punched up the chart for Cisco, and Cisco in the last 5 years is down here. It's hard to see when I move the cursor over, but you see that blue dot by the 7? I don't know if you could see it, but there's a little blue line that kind of goes along the bottom. That's Cisco growing at 7% over the last 5 years. And this green line up here is Nvidia going up by almost 1,900%. Now, if I showed you this in the year 2000, Cisco would be all the way up here. And a stock like, let's say, Fairchild Semiconductor or something would be all the way, down here. That is staggering. And it just goes to show you that the winners of one era are rarely winners of the next era. The only stock that I can think of that was a winner in the year 2000 and is a winner today, that's helping to carry the day. And before you say Apple, no, it is not Apple. No one bought Apple in 2000. That was like has been and never was. Apple didn't really regain their glory until about 2007 when they came out with the iPod. And that was more about a way to store more music on your small device. And then they came out with the iPhone, and then you saw what happened. But before that, it was not Apple. It's Microsoft. Microsoft and Apple were always in competition one way or another. And those two are the number one and number two largest companies in the world right now. Microsoft is number one, and right behind that is Apple. And they've been switching off between first and second place, $3 trillion plus valuations. But the stock of today's era is Nvidia, and it is done remarkably well. Now, for a long time, it wasn't the greatest thing in the world. In 2020, it was in the 40s. And who would have ever thought that the stock could go up to the 700s? It's just a remarkable stock, remarkable company, and they're at the center of artificial intelligence, the new internet, so to speak, just like Cisco was the leader of the old internet, Web 1.0. Then you had Web 2.0, which is kind of like Google and Amazon, and now you have Web 3.0, which is more like, let's call it Nvidia. These are just my analogies. These are not buy or sell recommendations, but I wanted to show you these. A couple of things I want to talk to you about. I'm not going to get into the math formula of a tax equivalent yield, but there are cases when a client may be better off with a municipal bond compared to a treasury bond, that's a bond issued by the U.S. government, or a corporate bond. So you take the yield, you divide it, you multiply it, divide it, you take into account a tax rate, state tax rate if there's one, and then you say, if a tax-free yield is 3%, to get that in a taxable bond, you'd have to get, let's say, 4.5%. So which is better? The 3% could be better because it's not going to raise your tax bracket. You're not paying any more taxes. It's not causing you to pay more taxes. One thing that tax-free income will do, it is included in determining your adjusted gross income for Social Security purposes. So it could affect your Social Security taxes that you pay in Social Security. Having said that, in many cases, especially in certain states like New York and California, tax-free municipal bonds do make a lot of sense. Now, municipal bonds are free from federal income tax rates. You don't pay federal tax. If you buy there are 7 states that don't have a state tax, but if you do, I'm talking not a state, I'm talking state, not estate with an E. So when I say a state tax, I don't mean estate tax. Okay? You get that? Estate tax? All right, good. So if you have any questions about this, or ask me in the comments, or send me a DM, or give me a call. My contact information can be found at clientfirststrategy.com. But in the case where it pays for a client to own a municipal bond and someone who's in a fairly high tax bracket and expects to be in a high tax bracket for the life of the bond, meaning for past or up to the time when the bond matures, it could make sense, for a municipal bond. And when it does, that's what we often will go for. Municipal bonds typically, historically, have had low default rates. They're not considered as protected as a treasury bond, which is backed by the full faith and credit of the United States, of the Treasury, the ability to print money, to make sure investors get their principal and interest. But it doesn't happen too often with municipal bonds. There's government obligation bonds, which are based on the tax base of the municipality, And there are revenue bonds, which are based on usage of a particular municipal project, like tolls for bridges and tunnels, that sort of thing. One could be better than the other for you. Some of them have what's called a sinking fund. And a sinking fund is that's when money is set aside by the municipality to help pay off the bond, to help pay at principal or at maturity. Those are considered a little safer. They therefore have a slightly lower interest rate. And then there's something called bank qualified, which means that in order to encourage banks to invest in tax exempt bonds from smaller, less frequent municipal bond issuers, these have they help small municipalities sell their bonds to banks that have money to invest, and by doing so, it helps the municipality out. Okay, it means that they're probably a smaller issuer, and the banks might get a better deal, and that's why they would buy it. There's a lot to know about buying municipal bonds. Some are callable, some are not. Callable means that even though a bond could mature in 10 years, it might be callable in 5 years. If interest rates go down, bonds that are callable could get called if prevailing interest rates go below the coupon yield of the bond. And if interest rates go up, you won't get called, but your bond value will go down until it matures because you could be investing in newer bonds which pay a higher yield. So a few things to know about bonds in general, a few things to know about municipal bonds. Now, if you buy a bond that's not issued by a municipality in your state, then that bond could be taxable by the state. For example, in the state of New York, if you buy a bond issued in the state of Ohio, then you have to pay New York state income tax on the interest. You're still exempt from federal tax. However, if you buy a New York bond, a bond issued within the borders of the state of New York by a municipality, the bond is not only free from federal taxes, it's also free from New York state income taxes, and it's even free from city tax, like in the city of New York. Okay, actual New York City taxes, you don't have to pay on that as well. So it depends on where you live, what the state tax is, where you live, and what your tax bracket is, what your income is. But a lot of times I do explain this to clients where they'll say, but I'm getting a lower yield on that bond, but I'm saying, but on an after-tax basis, you're getting more money. And that is really what counts. It's not how much you make. Remember, it's how much you keep, something to that effect, right? But taxes do affect investment decisions, in particular when it comes to certain kinds of bonds, like corporate bonds versus treasury bonds versus municipal bonds. So these are the things that we talk about as financial advisors. I just wanted to give you a super overly simplified expose on that. If you have any questions, again, please give me a call. Check out our website, Client First Strategy, for my contact information, or send me a DM if you want to talk about the tax equivalent yield for you and if municipal bonds are for you. All right, have a great day, and thank you so much for watching the live stream today, and I will be back with you tomorrow. And oh, by the way, happy Valentine's Day. Hope you have an enjoyable evening. Thank you.